Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me as always, Mangala Malu. Well, we've got a couple of management since it's earnings season, so let's get straight to that. Let's get chatting with the management of Mphasis. We have Mr. Nitin Rakesh as well as the CFO of the company, Manish Dugar, who joins us. Hi, gentlemen. Good morning from here in India, and thanks so much for staying up for us and wishing you all and your families as well a happy Deepavali in advance. Well, let's talk about business then. It appears, the street is a little bit disappointed with the numbers. So let's focus first on your mortgage part of your business. What portfolio of your business in terms of percentage comes in from mortgage? And also, are we witnessing higher furloughs than normal?
So I think overall, there's definitely some impact from the line of business you talked about. I think we haven't declared the exact percentage, but the part of the business within that mortgage LOB that is really sensitive to interest rates about low single digits. So we have seen some of that impact play out. We think we have a portfolio diversification mode there that helps us actually sustain some of that momentum that we've built over the last few quarters. And as this uncertainty gets a little bit more stable, we think that's a growth business all over again. So from that perspective, I think there's definitely a long-term growth view mindset on that business as well. On the furlough side, I think so far there was specific client issues that cropped up. We haven't really gotten any more indication than seasonality that plays out in Q3, so there's nothing specific to call out for on that front at this point.
Right, and what about Europe? 9 to 10% of your revenues. You have a revenue growth of around 10.6% year on year here. What's the outlook for the European business? How are the macros? And in light of that, is the deal win pipeline of what, $300 million sustainable?
I think, again, Europe is a business that grew really rapidly. It's definitely been a certain degree of, given that we are more UK focused within Europe, there's a certain degree of uncertainty there that has cropped up, as you know, with all the events that have happened. So I think we know, obviously currency plays an impact there as well. So we'll continue to see how best we can pivot and stay focused on a set of customers there that we can service and we have opportunity and room to grow with, while also building a new pipeline of customers. As such, we don't think that should derail the momentum from a TCV or a pipeline standpoint. Our pipeline is actually up 18% quarter over quarter, TCV wins of 300 million plus, despite the macro environment, despite the mortgage slowdown. Very pleased with that. And I think pipeline is a lead indicator. As long as the pipeline continues to grow despite deal closures, the TCV wins and the revenue growth will follow.
All right. I want to ask you about the rupee depreciation. We here in India, some part of us or some part of the stock market at least is fretting. Who would have thought the rupee at close to around 83 odd? But that'll be a bit of a tailwind, I believe, for your business. If you could quantify what was the benefit of the rupee in the past quarter, and also since we have a bit of a tailwind in this on this front, why not go ahead and up your margin band? I think you're in that vicinity of around 15.25 to around 17%.
As we have mentioned earlier, we believe in the philosophy of investing for growth while maintaining margin in a narrow band. So what gets reported as a margin is a puts and take of various investments that we want to make and the tailwinds that we have. As you rightly said, currency is a tailwind. We have a treasury policy where we want to make sure that we have visibility to a conversion rate for a reasonable period of time, typically over the next 4 quarters. So a large portion of what we converted to INR this quarter would have already been hedged, which was at a rate better than what we were getting in the previous quarter. So we would have had that benefit flow into the P&L. But it did not flow into the P&L to the extent of what the spot rate was, because the expansion in rupee dollar conversion was much more than what one would have anticipated. So yes, the margin expansion does happen with exchange. Exchange is a tailwind for the margin, and it's a continuous phenomena for the industry. And a large part of that was baked into our plan because we had visibility to what it will look like for Q2.
So the first couple of quarters, you've done margins of what, 15.3%. Your overall guided band is 15.3 to 17 odd percent. The second half, should we see it moving towards that 17% mark?
The reason why we gave the guidance of 15.25 to 17 was twofold. One is we were coming out of a Q4 when it was 15.2 and the industry was all worried about margin contraction. So we wanted to indicate that one, we will be ahead of what Q4 is at a minimum, which is why the 15.25. And the range was given that large because there were uncertainties in the macro leading to us not having surety of whether the supply costs will be easing or whether it will continue to be stressed. While we have seen initial signs of supply easing out and attrition levels moderating, but it is still at a level which is we would like to see going down. So as things progress, we have enough tailwinds, which gives us confidence to maintain that lower end. But whether those tailwinds can translate to an increased reported margin will depend on whether the headwinds are mitigated. And they are getting mitigated, but not at the pace at which we would like it to.
Yeah, the street is hopeful that the worst of attrition is behind for most IT companies. My colleague and me, sometimes we wonder whether we're in the wrong industry, with the kind of attrition you guys and the kind of hikes coming about. But that discussion for another time. Final question then, there was some hope that there'll be price increases that can get pushed through. Is that unlikely now?
Not really. I think, Nigel, at this point, the pricing environment is, I would say, stable to still tailwinded for the right type of skills and the right type of services. So I think there has definitely been realization at the client level that we are in an inflationary environment. They're seeing it in their business. They're seeing it in their employee pools. They're seeing it in their attrition levels. I think as we head into 2023, if the uncertainty gets worse or the macro gets worse, then I think we'll start, using the playbook of, vendor consolidation, driven wallet share gains. And at that point, I think there may be a little bit more competitive intensity on pricing. But at this point, so far, YTD current quarter, pricing environment is fairly stable and in fact has actually been helpful in mitigating some of the headwinds from wage inflation.
Do you have any maths on what the wallet share is with regards to all your clients, how it has increased or moved over the last couple of quarters, what the outlook is here?
I think if you look at our client metrics, top 5, top 10, next 10, new clients, all have actually grown very, very healthy in the 27, 28, 30% range. New client business actually grew just on a Q2YY basis at 53%. That is highly indicative of the fact that in almost all key relationships, we've actually continued to gain wallet share. And of course, it's a portfolio approach, so we'll continue to deploy a playbook. We, in fact, detailed that out at great length in our earnings report an hour or so ago. So I think the playbook definitely calls for aligning behind where the client budgets are moving, which is largely in favor of transformation projects, cloud and data standard as 2 key areas, as well as in helping them shift the dynamic between run the business and change the business spend. And the third one really is as we see opportunities for vendor consolidation, wallet share gain becomes a really key metric by deploying cost takeout and other measures as well.